It's one of those weeks when central banks take centre stage, although whether markets still feel they're omnipotent is a matter for debate, after former Fed Chair Janet Yellen's admission that her 2021 message about inflation being transitory was off the mark. To err is to be human after all, but maybe such refreshing honesty will remind markets of the risk of central bank policy error, as the authorities potentially face a choice between raising rates and slowing the economy down on one hand, or letting inflation run away and do damage in a different way, but with possibly the same result, on the other. That sets the stage for the next policy pronouncements from the US Federal Reserve on Wednesday the 15th of June, and our very own the Bank of England on Thursday the 16th. So far as the Fed is concerned, in May, the American Central Bank hiked its headline funds rate by 0.5 of 1 percentage point to 1%. That was the US Central Bank's first 50 basis point hike since May 2000 and was enough to take the Fed's funds rate to its highest level since February 2020. Chair Jay Powell also firmed up the Fed's quantitative tightening or QT policy, as it seeks for the third time to withdraw quantitative easing. This is an effort to both reduce the reliance of the US economy and America's financial markets upon cheap, easy money and rein in inflation by dampening demand. The plan is to reduce QE by $47.5 billion a month in June, July and August, and then step up the pace to $90 billion from September. Total Fed assets stand at a record $8.9 trillion, more than double where they were before the pandemic, and 10 times what they were before the 2007 to 2009 Great Financial Crisis. So even $90 billion will take a long time to get rid of that lot. And prior attempts at QT in 2013 and 2018 to 19 ended in the face of the so-called taper tantrum and then an economic slowdown and the pandemic, respectively. So it'll be intriguing to see how bold the Fed feels it can be this time around. In terms of the June meeting of the Federal Open Markets Committee, the CME FedWatch survey suggests markets are putting a 98% chance on another half-point increase to 1.5%. Also watch for any guidance on the July meeting, when a half-point increase to 2% is seen as a 93% chance. By the end of the year, after 3 more Fed meetings, markets think US headline interest rates will be touching around 3%. Now back home at its last meeting in May, the Bank of England pushed through its 4th rate rise of this cycle, a quarter-point increase to 1%, and announced that quantitative easing stood at £867 billion, down from the peak of $895 billion. Markets are pricing in 25 basis point increases for June, August, September, November and December to get us to 2.25% on the headline base rate by year end. That's a slower rate of progress compared to America, and that forecast interest rate differential may help to explain the pound's latest slide against the dollar. But it's quicker than the expected pace of increases from the European Central Bank, and that may be one reason why sterling do a better job of holding its own against the euro, although the currency is well down from the levels that prevailed before the EU referendum vote, which, believe it or not, was 6 years ago this month. Now, the pace of corporate news is also quickening as we pull away from the Jubilee weekend, as the list of scheduled results releases or trading statement lengthens. Names which may be worthy of further research include the following, although do remember some of these names could yet be subject to change. Saga on Monday the 13th of June, Ashted, Bellway, Oxford Instruments, Boohoo and former FTSE 100 member Ferguson on the 14th. Whitbread, Foxtons, WH Smith, Bloomsbury Publishing and AO World on the 15th. Halfords, S4 Capital, N Brown, Biffa and GB Group on the 16th, although Biffa may now be a little bit delayed because of the takeover. And Tesco on Friday the 17th of June. But for all of those names, the company which could yet cause the biggest fuss in the coming week is FTSE 100 member Halma. This company provides a solution to a problem, in that its hazard detection and life protection systems, locks and devices help companies meet regulatory requirements and keep staff, customers and clients safe. The mandatory nature of investment in this area creates consistent business flows and sticky customers, a combination which gives Halma a degree of pricing power. That in turn can mean high margins, good returns on capital, strong free cash flow, and a growing dividend for investors over the long term. And it's Halma's dividend track record which could again write the headlines in the coming week, The analyst's consensus forecast is for a full-year payout of 19 pence a share, and an increase of 8% on the distribution for the year to March 2021. If this forecast is met, that will be Halma's 43rd consecutive increase in its annual dividend of at least 5% or more. Now, it would also keep the Buckinghamshire headquartered company in that elite list of just 17 FTSE 100 firms that have managed to increase their annual dividend each and every year for at least a decade. Besides the dividend, analysts will be looking at the headline sales, operating margin, and pre-tax profit figures. On a headline basis, the consensus sales forecast is £1.5 billion, up 13%. The organic rate of progress may be of more interest, and at the first half stage that was 23% on a constant currency basis, although the base for comparison got a lot tougher in the second half. When it comes to the operating margin, Halma's management has a target of 18 to 22% on an adjusted basis, and at the first half stage it came in at 21%. And for pre-tax profit, analysts are looking for a 10% advance to £307 million from £278 million on an adjusted basis, with a statutory number coming in at £287 million. For the year just begun, if management feels able to give any guidance, consensus is looking for a further 10% increase to £339 million on an adjusted basis. More strategically, watch out for updates on acquisitions, as Halma uses select purchases to supplement its organic progress. In March's trading update, Chief Executive Andrew Williams revealed that Halma had made 13 acquisitions at a total cost of £166 million in the year to March 2022, and the firm's kicked off the new financial year by snapping up Canada's Deep Trekker for £36 million. Thank you for watching. I hope that you and your families are in good health and good spirits, and I look forward to seeing you again next time.